Hello, welcome back, Joachim, and everyone watching. This is our final step of the customer profitability webinar series that we're doing, and we're now going into step 4, performance tracking. Talk us through this, Mr. Spreadsheet.
Yeah, this one, it could be a little bit too content rich and complex for those who are not into numbers. I'll try to do it as straightforward as possible, but probably this could be something that you might have to review a few times to get going. I just want to do, like last time, do a super quick recap. So how did we get to this step 4? How we see the success now in the numbers? So if I can start in that end. Let's see, like this. We identified as a first step what we call the high impact project based on certain considerations which were both strategic and financial. On that, we then listed all of our different projects and we sort of rated them 1 to 10. We also looked on the profitability on the project level, and then we came up with a final score, and that final score were then divided into 3 areas. One was then where we needed to protect, the other one where we needed to nurture, and one was really where we needed to act. So we also then took all these projects and say, if we take all our projects we have in the business and see which ones are contributing the most into our business, and normally have the Pareto rule with 20% contribute 80% of the profits and so forth. So as a summary of that part, doing that full exercise, you came up with, we said the green and the yellow and the red: protect, develop, and act on. And that led also to the discussion where you can sort of do this on a semi-annual basis, move very sort of diligently, involve the team in this discussion to define what is high impact for us, what sort of resources we have. So this led us into the second part of the discussion, which was then, how do we now make sure that our resources match these high impact projects? And so we can do that, the skill base we have today. So then we moved into the resource allocation. And here we just exemplified it within a few different ways. We said that if you look over time and you have low billability, which means that you have a lot of staff sitting on work that's not necessarily billed towards clients, it could be, of course, going up and down, and you can use that with having a sort of a broader skill base where you can reskill and upskill people, so you can use them in different kind of projects. But it could also be that you use freelancers or third-party suppliers. But the better you get in defining high-impact projects, the easier it is for you to sort of focus in, to be laser-sharp focus on how you skill you and train your own people to match those high-impact projects. That also should make your billability go up for those resources. So that was the second step we looked into. So you can say step 1 and 2 very quickly was to identify the high impact project, categorize them into A, B, and C clients, or we call it red, yellow, and green, yellow, and red. And then for each of these categories, you developed a strategy where you devote resources depending on your actions. And then you also look on the resource planning to allocate resources, short-term, medium-term, but also long-term utilization. And the whole rationale for that is the right person at the right place. And please remember the last one, the right person at the right place. We're going to come back to that one a little bit later. Mm-hmm. And then thirdly, we said, okay, this is all fine. We've done a lot of sort of exercise now where we worked with the different projects we have. Now it's hands-on. How do we do this in practice? So the last time what we went through, we actually defined that in order to execute on these plans, there is a need for a dedicated role to manage the daily twists and turns in this. In our what we did last time, we called it a gatekeeper. People call it like a project coordinator,
resource manager, operations manager, something like that. Yeah.
But we went through the role of that one. What was important to remember here is that that person has to have a certain weight in the organization, because that person is the glue between sales, resourcing, or sales and operations, if you want to put it like that, where you had team leads in projects are normally sort of overprotective, sales are underprotective of resources. They pull them in and out. So that person is really to align across the organization. And that person is such a central figure because it has to create the respect for all the tasks needed, and sometimes has to take a little bit tougher decisions. It also highlighted the relevance then to have all your systems updated, which means the product tools you use in terms of logging hours, as well as on your sales system, the CRM system, etc. So you know that what you have in your pipeline is actually reasonable to fall into place, so you can plan also resourcing going forward. And we said in order to, at least initially, it needs a lot of management attention to make this work. And as always, the devil is in the detail. The more you can do of this, the more focus you set on this, the better you will come out of it. So you can say, summarizing the step 1 to 3, hopefully you then have focused in on the projects you know you're profitable, where you can deliver, which are strategic, really relevant for you. You have also looked through your resourcing, understanding that these are the resources that we need to match that, and that's going to increase our percentage of billability towards the client, and we have now an operational model to make this work. So the last thing I want to go through is really, how does this now fall through into your profit and loss or income statement? So that means that we're moving in how this all ties together with your overall growth and profitability.
Nice.
Does it make sense so far, Claude, or is it too?
Absolutely. Yeah, no, that was a great synopsis, and all 3 videos are in the classroom there in Thrive. So people can go back to them. And I think any questions in the Thrive platform, you can just ask a discussion. We've got a thread there on finances. So if you're watching this, the recording, and you have any questions, pop over to the discussion area, go to finance and ask your question there. Both I and Joachim will be in there regularly. And if we get any more questions on a specific topic, we can always open that up and have a webinar specifically about the questions that you're asking. So good.
Yeah. So what I want to go through now, I will try to do it as pedagogic as possible. It's to break down the P&L, or the profit and loss, in very simple terms, and also touch upon a little bit the edge, tie it back to the high impact projects, how we have sort of decided to define the market and what the impact that has on your profit and loss. And then also added to the second step, where we talked about the resourcing it correctly, meaning that about 80% of your expenses are actually staff related. So how does that reflect in your profit and loss? And finally, then the last and very important part on your profit and loss is how you price your services. So I want to also touch a little bit on that, how all on that ties into your overall profitability and growth. Nice. So let's start on the first one, the simple profit and loss. Very, very simple. And I think this is open doors for most of you, but I just so we sort of align where we are. You have what is normally called your revenues. That's really what you've sort of been invoicing in a certain period. Normally that's invoiced over a period of a month. When we started, and the first thing we did on the different projects, we looked on those that were project-related revenues and those that were recurring. Recurring is normally like market retainer. You have maybe a 12-month contract, you set up a fixed fee per month, and you do certain work within that space. Project could very much be that you do an integration or something, you're launching a new system, a CRM system for the client, or you have a specific campaign that you have sold, or it's a web project, etc. Then that maybe runs over a few months. It's a fixed price for the whole project, but then it's a little bit undefined what's done on a monthly basis. Altogether, that adds up to your total revenue. And in this case, the example, we made it simple. So we said this is 100,000 on a monthly basis. In order to deliver on these revenues, you need to have some costs. And as we said, majority of the cost, if you're a service business, is staff related. That could be admin staff, of course, but it's mostly, hopefully, operational staff that are working towards clients and generating these revenues. You might have some direct cost. It could be pass-through revenue if you do media purchases for a client. It could be that you have some freelancers that are working on a specific task. So they only work for you specifically in one specific project. And then you have something called other operational expenses, or OPEX. That is everything from premises, from IT systems, from travel and marketing you have on your own in order to generate leads. And those also is something that you have to account for in your profit and loss. And hopefully at the end, there's something over. That's the difference between the revenue and the cost. We said the revenue was 100,000, cost 90,000. So the profit in this case is 10,000. Hopefully pretty straightforward and simple. Now, let's take this one step further and just discuss about the most common KPIs that you will hear when you're out there talking. Some of these KPIs are revenue based, at least on the, you can say on the left column that we had, the project and recurring combined. I think very often you will hear something called ARR, or if you work with software companies or software as a service, they very often talk about ARR or MRR. That is really what is our recurring revenue on an annual basis. So this means annual recurring revenue. The reason why this is relevant is that for many people, they say, okay, we have this contract, so we don't need to sell this new every month. So every month we go in with this value already sold. And then whatever we add on top means that we have the ability to grow. So that's why ARR business is normally very, very positive to have. That means that you only sell on top of that, and it's easy to grow with ARR. For project type business, you need to resell and resell and resell. In this example, I said that half of the revenue of 100,000 was recurring. So that means that 50,000 of the monthly sales is recurring revenue. So 50,000, and it was annual, so times 12 means that you have 600,000 in ARR in the business. Next month, if this one has grown to let's say 60,000, then it's 60,000 times 12, which is then 720,000 in ARR. Is that clear?
Yeah, absolutely.
Good. The other revenue related one is to take the full column here, the 100,000, and compare it with the most important resource that you have, that how many staff, if we're a service business, do we require if all of this is sort of service related revenue? It could be retainers, as we said, or it could be project-based services. So of all that, if we have, let's say in this case, 15 staff members generating a certain cost for us, but these 15 employees generate 100,000 here. And how much is that on an annual basis? Well, we take 100,000 times 12. That's the revenue on an annual basis divided by the 15 employees we have, which means that every year we generate 80,000 euro per employee.
Right.
That's a very important key ratio to we're going to come back to that one.
Yeah.
And then we can also look on the result-based KPIs. So if you start with the first one that you hear for companies that do, again, software services, industrial kind of business where you have products, you talk about some sort of gross result or gross margin. Then you take the full revenue column again, but only take away the direct costs you have, those directly related to the business, to the revenue generation. In this example, I took 100, and then you had some direct cost here of 5. So it's 95 is then the gross result. And very often you hear gross margin. That's just doing the same thing. You take the actual result divided by the revenue, which means that the gross margin is 95%, which is a very high number. The more common result-based figure to look on is something called EBITDA or EBITDA margin. EBITDA is really just another name for the operational result. It's earnings before interest, taxes, depreciation, and amortization. So I don't think you need to remember all that sort of definition, but you might come across EBITDA quite often. And if you are in M&A business, they talk about EBITDA multiples, which means you do multiples on your earnings, right, as a valuation.
Yeah. Just, without going on a tangent on that, just on that mergers and things, ballpark, a question I get asked all the time is valuations. Obviously there's a lot of due diligence and things need to be looked at, but like a back of the napkin number, what is currently sort of what EBITDAs, what valuations are you seeing right now times EBITDAs?
Yeah, there's so many things influencing that, but you can say, if you can see that the EBITDA has a growth trajectory, so you can show that it's been growing year over year, and you have a growth story attached to this, and you can see maybe the last 3 years that this is improving. If you have an EBITDA going up and down, So you've been positive 1 year, negative 1 year, and positive 1 year. Then you might look on transaction rates of 3, 4 times EBITDA, so very low. If your EBITDA is generated by a lot of recurring business, which means it's quite stable and it's also growing, you might be talking about 6 to 8. It is a very if it's a very sort of strategic position you have, either as a business or the type of clients you have, or in a specific partner system in terms of space, your EBITDA multiples might go up to like 12 times EBITDA.
Right.
But that means that if all of these things are in line.
Of course, yeah. No, I didn't want to distract, but as soon as
But
I
hear average is probably between 6 and 8 is a good
it's good, yeah,
it's a good valuation to have sort of a back of a napkin.
Good. Okay. Back to our back to the topic.
So in this case, you have the column here being the revenue, and then you have all your operational expenses, including staff and direct costs, with listed that as being 90. So the EBITDA is then 10,000 euro, and the EBITDA margin is then 10 divided by 100, which is 10%. So you have a 10% EBITDA margin. So far, so good. But again, coming back to what we said, I think the most relevant for things for you to understand, because we are tying this back to the project profitability and the ability to manage your billability within your projects. So it really comes back to how well you operate with your employees, how efficient you are in the use of employees. And since we said employees are probably about 80% of your expenses, or even more sometimes, let's touch on the revenue per employee and the profit per employee. And here there are some rule of thumbs that are, of course, super generic, but you could say if you're a healthy business, normally you say that we should generate 100,000 euro per employee, then we're in a healthy situation. I think in the example we had last time, we had about 80,000 that I showed you just before. Up here, we said 80,000 euro per employee. The other part, the profit per employee, 10,000 euro per employee. In this case, that's the sort of the benchmark. We didn't calculate that on the previous one, but we could, of course, do that if we want to. We said that we had 10,000 on a monthly basis. That's 120,000 per year. And we had 15 employees. So we just simply take it. I have to do it now. I haven't done that in advance. We have 120,000 divided by 15 employee. So we have 8,000 euro per employee in profit. So we're slightly below, but we are in range to reach these targets, 100K and 10K euro per employee.
Super.
So now we're moving to a little bit more complex setup. Let's tie this all together in one picture. And that's going to be challenging. I'm just pre-warning you, because now we get into this setup with the knowledge-based companies. What I have here is sales or revenue. Look upon this as being the column, the left-hand column on the revenue that we talked about. Your sales are really comprised of two things. It's the volume of retainers, volume of projects, or volume of hours you bill on a monthly basis, times the price you're able to charge for those. That's what ends up being your invoiced revenue or your sales. So I want to just break this down a little bit on this volume. If you start then with the volume part on that column, how do you sort of grow your volume over time? It's really depending on which market you're in. We started off in the first step talking about the high impact project, and that could be that you had decided with that we're going to be in this vertical. For instance, you're going to be in the health side, focus on health businesses only. So that sort of defines also your market with these kind of services. This is going to be our offer. And there you can sort of then define that this is our total addressable market. Maybe you even cut it down to be a certain geographic market. Within that space, you have a percentage market share. That's going to be at the end what creates the volume for you. And for you to increase your market share or increase the volume, you can do two things. You can either go into an adjacent market or add on services, or you can look on your market share. Can we increase our market share in this space? And that's again why it's so important to be super strong and understand what your high impact projects are. And your market share, you can really improve by better understanding the customer needs. So you sort of match the customer pain points with your unique selling points to a better sense. And then how you're presenting your offer and packaging your offer is super important, plus what sort of competition you have in there. Eventually, hopefully, if you do this right, you will get customer satisfaction and you get repeat business. You can do upsell and cross-sell of new services, which is normally the least friction to get additional business, which will increase volume. Price, I want to come back to a little bit because that's so relevant. The cost side, now we move from the left column back to the right column where we had all these expenses. And I really want to say that let's not focus on the OPEX, which is like the selling, the general administrative expenses, premises, and so forth. Let's focus on like the majority part here, which is people, staff.
Yeah.
Then it comes back to what we talked about before. The reason this is really a cost we want to increase if we know it's billable. If we can increase the actual cost and we can bill it to clients, we actually increase sales more. So here again, we talked about these utilization rates, the productivity we do. Can we standardize the way we work? What sort of knowledge management do we have? Can we use subcontracting or upskilling, etc., to take off peaks instead of going outside? That's why this one sort of fits into this. And then we said on the previous slide here that instead of just comparing this to like how much we need to invest or anything, let's compare this to the number of employees we have. So this one, this is the left column, this is the right column. So remember the end of this was actually the EBITDA. So what is all the, what's the income or the EBITDA per employee? So here we had the 15 employees in our example. So it comes back to the, how do we then now work with our employees? The utilization rates, the motivation, how much can we build to clients? Coming back to what I said in the beginning, this is what we mean when we talk about right person in the right place. So hopefully you can see how we try to tie it a little bit together to everything that we talked about through step 1 to 3. And there's so many soft things in here that are 15 employees is just a number. At the end, all these soft things, how you operate this business is what's going to end up showcasing how efficient and how well run it's going to be. We have tried to sort of showcase the tools for this. So this is sort of tying it up, why these KPIs will be showing. If you have done a good work in defining your high impact projects, knowing where you want to be, you know which clients you want to go after, that means that you're going to have less friction to create a bigger volume. On top of that, if you then also have the right skill set, long-term utilization is high, you operate with a certain standard, you know that your quality is going to be equal whenever you do the same things for your clients, and you're handling your other OPEX in a very controlled manner. That means that you're going to be efficient on the number of employees to generate the sales needed, and that's going to leave you with a bigger profit or income per employee, as we have in this example. So lastly, I want to sorry.
just on this as well. This is what comes up for a lot of agencies over and over again is I can't get my team to track their time, right? Because what team, unless you are explained the importance of the utilization number in an individual's contribution of their efficiency on doing great work that gets results for clients in a reasonable time frame, that when everyone's doing that and everyone's tracking that and it's visible, the agency succeeds. So when I have if anyone wants to go back, I have a whole talk on this, a video that you and a deck that you can adapt and educate your team. If there's resistance in tracking time or someone doesn't understand it, what they don't understand is no more than if this was like an industrial company, if this was their machines that the cog wasn't working, the machine doesn't work, the product doesn't get, and that is when everyone understands that they are an important cog in a machine, which is the agency, and the product is happy clients, repeatable clients, and healthy clients, and things done efficiently. That when they start to understand, it does change everything. So this slide, is when it's presented and explained to individuals who work in an organization, that aha moment goes on. Oh, right. So those team nights that we have, those team buildings that we have, that bonuses that we get are directly as a result of my contribution to being an effective and efficient and productive person in this organization. It changes everything. So I think if people are struggling with that, go back to the classroom, and there's a video there about time management. I just wanted to link that because it's just an important, it's really important when somebody hasn't worked in professional services or an agency before. They think that the money happens up there, and it's like the money is actually generated by you, like the individual. Yeah.
And I think you're touching on something that I think is so relevant and so I think looked over so many times, which means that I think you should involve everyone in understanding their why, why you get to work, why you are in this project, what's your contribution to the market, to this company. Everyone wants the company to have a sustainable business over time, and because it makes the situation enjoyable. You're actually going to work with fun projects. You're going to work with a company that's going to survive, that can do additional things to keep people motivated. You can do training. You can sort of grow as a person. If there is enough sustainability in the business. Or the other way around, if this is not happening and you're not taking actions, eventually you will have to take action, and that means that you're going to start cutting travel, you're going to start cutting this, and you're going to start cutting training, and all of a sudden you have to redundancy 2, 3, 4 times a year because we are not managing this right. We don't do the planning right.
Mm-hmm. Great.
So the understanding, and you can break that down to this to each individual in the morning. I'm in a project, so I'm billing this much every month. This is my cost, and this is how much I need to contribute to the business for it to be sustainable.
Yeah.
So
yeah, very important. Yeah. It's a big thing, especially with just, especially if somebody hasn't worked in this industry for, and they're like consistently not tracking their time, it's because they think, oh, it's a fruitless exercise. There's no point, or you're micromanaging me. It's like, no, it's not how it works around here. It's very different. So great. Thanks. I just wanted to cover that off because it just comes up over and over again.
Well, it was really super. What we didn't talk so much about price here is, but that's because price for generating sort of an income at the end, you don't need to touch the number of employees for changing price. You don't touch the cost, but you have to touch the client to talk about price. So I want to talk about price, but also how can you sort of improve this ratio with both the combination of price, volume, and cost. So I want to do a quick example, finish off with that one to showcase the different levels. So let's start with the basics. I think we had a case where we said that you're selling, in this case, let's say 100 retainers. Each retainer is $100. They cost us $90 to deliver, which means that our revenue is then the volume times the price. That's 10,000. The total cost is then the number of retainers we produce or deliver times the volume. So it's 9,000. It gives us a bottom line of 1,000.
Nice. Yeah.
So if you recall, 1,000 divided by 10,000, that was the EBITDA. That's
right.
EBITDA margin is then 10% in this case.
Mm-hmm.
Now let's say that's not sustainable. For us to sustain, we need to be at the level of 15% or 1,500 if we are selling at 1,000. So let's start with the price as a tool. If we take a look, if volume and cost stays the same, that meaning that we don't need to add additional hours to increase price. We don't need to sell more to increase the price. How much do we need to increase the price in order to increase the profit with 50%? We actually need, in this case, we don't change the volume. We keep the cost the same. Is it then 15% price increase? Is it 5%? Or is it 50% in order to reach 50% down here?
You see, my gut says 50%, but no, it's wrong.
It's a 5% increase.
Yeah,
and
imagine.
I think, you have so many reasons for taking this seriously, the price discussion. It's a combination that can you actually do something on your service packaging? Are you coming into a new calendar year? Can you do some sort of index regulation in your contracts? There's a lot of discussion to have around price. And cheapest is not always best, but so price, don't be so scared to talk about price with clients. The impact is immense. It's really, really big. So in this case, let's say we had 105 price per unit. It still costs us 90 to deliver, which means our revenue is all of a sudden 10,500. Our cost is the same, and the bottom line ends up being 1,500. So that's price.
Huge.
And we talked about the, how you can work with your offering, and you can work with you being a thought leader, or work with your specific vertical, etc., to motivate a premium on what you're doing.
Right.
But I really believe only in this community we should have a lot of sessions on price alone. There's so many smart people on how to work with pricing.
Absolutely, yeah. And how they renegotiated contracts. I just had that conversation during the week with a new agency. They realized, when you're going out getting the business, they kind of undercut themselves, and now they can see that they're kind of breaking even on some of the packages, and they're asking me, well, how do we increase the price? And it's, this is the importance of having a partnership, a relationship with your clients, so that you can easily go in and just break it down and explain it to them. Look, how things cost. You shouldn't be afraid to have a pricing conversation with a business. You should have a good working relationship with them, so that when you sit down around the table, they understand and you understand, and it's not an argumentative situation. It's more of a collaboration, because they've been a partner with you.
Yeah, that's a good point. And also, I think in this case also we should be aware that pricing is so complex, and it's a lot of discussion. Do you disclose the price on your website, or is that going to be competitive? But there's a whole line of communication around that, and I think that pricing is a really separate discussion that you can go very much in depth to. So then let's look on volume. We said that we want to increase from 1,000 to 1,500. What if we just we just need to sell more retainers. We need to increase the volume of sold retainers. In this case, we kept this volume the same. So we're just working with the clients to discuss a price change of 5%. Let's say, no, we want to reach 1,500. We're still not doing anything about the cost. It's still each retainer costs the same to deliver, but we want to increase the volume. So that means that the volume is unknown. The price is the same. The question is then, do we need to increase the volume with 25 new retainers? Are we talking about 50, or are we talking about 100 new retainers? So in this case, it's actually 50. So we need to increase the volume with 50% to increase it down here with 1,500. Which means that you get 150 sold retainers. The cost is the same, but the revenue is then 150 times the price per retainer, which was 100. So that's 15,000. The cost is 13,500, because we're now delivering 150 and we have 90 per cost. So it's 13,500. It gives us the same bottom line. So far, that looks good, right? That's one way to do it. But imagine you go to your salespeople and saying, listen, you just need to sell 50% more.
More, right? And then the services team, hey, you need to deliver.
Yeah, that's the other thing. All of a sudden you tell to the services, I know we're fully booked, but we need to plan for another, we're going to generate another 4,500 in this case, that whatever that means in terms of.
Yeah. So you could be increasing the team, that's where that cost is going to come from, or you keep the team and there's more workload.
And you need to go into a situation of maybe hiring people. That's going to cost you money and time. You might come into a situation that, our premises are too small. We need to look into new premises. So there's a lot of things attached to this one. So the volume raise is, of course, you want this growth over time. But if you try to do that one in order to hit the new bottom line, that's not necessarily the best way to do it. The thing is, though, on the terms of the KPI, we talked about the sort of EBITDA and EBITDA margin. Here we said it was 1,500 divided by 10,500. So that's actually that's above the 10% that we had before. 1,500, I'll just do the math here now, divided by 10,500. We did go from 10% here to 14% in EBITDA margin here. So all of a sudden we looked as if we are more profitable. In this case, we go back to the 10% EBITDA margin, because we have just, we did not do an increased margin. We only increased the volume. Okay, now let's say if the salespeople say, okay, if I'm going to sell more, I need to give a discount. I cannot sell more without being very aggressive in the market and talking to clients. So let's say you negotiate as a salesperson saying, okay, fair. What if we drop the price by 5%? It's not a big drop and probably not enough in order if you're going to really push volume high. But what volume would you need to have if you drop the price with 5% and still want to hit the 1500?
Mm-hmm.
So we go back, the volume is unknown, the price is now 95.
Small discount, but
Small discount. Do we need then go to from 100 to 200, 100 to 250, or 100 to 300? In this case, it's actually we need to triple the volume if we give away a 5% discount. And this is such a lesson, I think, in people saying that let's undercut the price. I mean, the moment you go into a price discussion, imagine how much you need to work to compensate that in order to sustain your bottom line. This, I think, is just hopefully an eye opener for a lot of people.
Yeah. It's only a small discount. It's only 5%. You know, you hear that, and it's yeah.
And of course, this is example. We're saying that you have 9,000 in cost and etc. So, and we assume that all the costs are variable. But in generic, the pricing mechanism is hugely impactful. So in this case, you're actually having 95 in revenue per retainer you sell. You're selling 300 retainers. The cost is the same per retainer, which means your revenue is just booming through the roof. You have 28,000, looks fantastic. However, your cost is following along, and the bottom line is then the 1,500. And this doesn't happen overnight, I can tell you. This is a long journey. And now let me give you another example. The 1,500 divided by the 28,500, all of a sudden you're down to a 5% EBITDA margin. That's starting to become a little bit risky, because here you sit with a lot of fixed costs. So if volume drops for some reason, you're very soon in the red and your business is in danger. Okay, so finally, let's finish off with the last one, which is coming back to everything we talked about in step 1 and 3. Let's say you can actually manage your resources really well. You have a gatekeeper or a resource manager that's super talented. You have defined a high impact project. Your skill set is matched really well. So you're starting to realize that actually we can see that we can work more efficiently by focusing on these projects, which means that we keep the existing clients, we keep the price per retainer, but we can actually deliver this, let's say in this case, cheaper. How much cheaper do we need to, or cheaper or more efficient, which means that we either have a higher billability or we spend less hours on specific projects. In order to hit the 1,500, do we then need to be 3.5% more efficient, 5.5% more efficient, or 7.5%? Here again, we talk about 5.5% more efficient. So if we take this on work hours, let's say we have 40 hours in a week, we're talking about 2 to 3 hours more billability by being more efficient per week that we need to find. I think that's a very small number and very logical number to go after. Plus, we don't need to confront the client with this. We don't need to sit in front of the client and try to negotiate the price change. So that means that you actually go from the $100 per retainer to $85 per retainer in this case. So you still have the same revenue. The cost base is 8,500 and the bottom line is 1,500. And again, let's do the EBITDA margin, which is 1,500 divided by 10,000 this time. So now to 15%. Well, actually, I could have done that without the calculator, but now we're up to 15% margin. And you start to look super healthy. And you are healthy because all of a sudden you have a full control of your business. And this is, of course, never black and white, and you're always going to be drifting between these things. But that's why it's so important to follow up on this. And the best case is, of course, when you can combine this with a price increase and having the ability to drive volume, but in a controlled manner, so you can employ and build your competences without creating a chaos internally.
Yeah,
that's
Amazing. And that 5.5%, I know when we first started talking about, when we first started created Grow It, over 6 years ago, there wasn't even remotely the amount of tools, and specifically now with the AI tools that are coming out, it is more than achievable to reduce the costs of producing the high quality services in a timely manner that gets results for clients. You could easily do that. You could have a 10% saving, would be very achievable, right, with all the AI tools that are coming out on a daily basis right now. So brilliant.
So this is pretty much this is the way we try to sort of tie it up, how the work you do, where you think you sort of sit and look on one project, the profitability and sort of the importance, and rate it, how you take that all the way through to defining where you want to go, defining which market you want to be in, defining your skill base, what it's going to look like, and have someone to operate that in a good way. This is what it's going to come down to on your bottom line. So I personally, I do believe that this is, I would say, the nitty gritty in this is that this is 90% of running the business successfully.
Yeah.
To be able to operate this.
Well, that's brilliant. Thank you so much. That is a wrap on our 4 sessions on customer profitability. And thanks a million, Joachim. We will see you in 2 weeks' time for the next part of what we're going to work on, which is wrapping up your agency financials for the end of year, because we're recording this on the middle, sort of towards the end of October, and we're coming into that November, December stretch. So that's what we'll announce the details of that in the Thrive community very soon. Thank you so much, Joachim.
Thank you. Thanks a lot. Good. Was it okay?